FinTech has spent the better part of the last decade promising to reinvent financial services. But if you look at the moment we're in right now, well, the conversation feels different. Funding is tighter, expectations are higher, and a lot of the easy narratives about disruption are being replaced with tougher questions like what's actually working? What's been transformed? In other words, FinTech may be hitting its awkward adolescent phase, past the hype, but not yet fully grown. So, in today's episode, we're going to sort through the signal and the noise. Which trends are actually changing how banks work? Which ones are mostly, the FinTech theater? And how do institutions decide what's worth pursuing versus what's just the latest headline? Joining me today are two people who see this landscape from very different vantage points. Alex Johnson, founder of FinTech Takes, spends his days analyzing and challenging the narratives shaping fintech. And Meghan Kober from US Bank sits on the side of who actually decides what innovations are going to get deployed within one of the most innovative banks. Together, we'll dig into where fintech really stands today and what the next phase might look like once the noise settles. This episode is part of the FinTech Exchange recording series at the University of Utah, powered by US Bank. Alex Johnson, Meghan Kober, really excited to have you. And this is an episode, frankly, for the FinTech Exchange podcast, sponsored by US Bank, on the hottest of takes. This is going to be some hot takes because we're going to talk about where are we in the maturation of FinTech. And I think we're maybe in the awkward adolescence. Part of to set this up, how to talk about, I was on the phone with my girls this morning, and there was a lot of screaming in the background. One of the realizations I had, and Alex, maybe this is something when you call home, you get as well. It's really hard to distinguish, is my oldest actually hurting her younger sister, or are they having fun? It is the noise versus the reality of the situation. Where are we? And so, opening question for each of you, in one uncomfortable sentence, what is the state of fintech right now?
Polythene.
Ooh. Say more words.
So I was reading, the pace of change is just like accelerating so much. And I was reading a New York Times article that was talking about this new era that we're in with the acceleration of all of these convergences of this technological advancements and how it's impacting society and our economy. And it's really hard to kind of decipher between noise and signal with all this content and all of this information at our hands. And so really being able to look at leaders, look at the horizon and see what is coming and how you can build towards that and really kind of sort out that noise from signal. We are very lucky on the FinTech Acceleration team to be able to work with venture capital partners and be at conferences such as the FinTech Exchange to really understand where the industry is headed, but then also working closely with the business lines to understand what are they working on today and what are the pain points and capability gaps that they have. And we put together FinTech focus areas, which is really priorities around where we focus and where we can really add the most value to our organization. I loved your article on the 2026 priorities. And so I'd love to hear a little bit more about how you prioritize and look at your signals and decipher the noise.
Yeah, I appreciate that. I mean, building on your point, I think that the thing I have kind of realized about where fintech is right now is that there's a real tension between how fast the technology is evolving with how quickly we can actually like wring value out of it, right? And part of that has to do with just the speed of regulation and the speed at which like regulated entities can move. But even like I look at more mature fintech companies that are pretty thoughtful about like, okay, how does this actually translate into value for customers? And even they are really struggling with, every week something new is changing with AI or something new is changing with payments or something new is changing with digital. And they're really struggling with like, how do I translate this new technology? Like, should I pay attention to this? Should I pause right here and work on this, or should I wait for next week when the next thing is coming and then pause for that? And I think that, I mean, you guys do a great job of building like a process and a discipline internally to pick out which fintech trends matter and which ones are just ones we sort of want to let the pitch go by and not swing at. But I think for everyone in the ecosystem, they're struggling increasingly with, there's a million pitches coming by really, really fast. Which one do we choose to swing at? Because you can only swing at so many, and you want, when you swing, to actually make contact and like drive value for customers. And I think that's become harder than it ever has been since I've been covering fintech.
And they feel like it's all moving at, like, the balls are moving in different directions, right?
Yeah.
Pitches are going one way, the technology is going one way, like regulated entities, rightfully so, are lagging. But I think in the center of it, like, even the value is lagging, right? Like, the pitches are ahead of the value right now. So Megan, how are you guys making sense of that in terms of, like, there's just so much going on, so much the business can absorb. How are you prioritizing what's relevant now versus in the future?
Yeah, so we have fintech focus areas that we kind of use as our priorities and work very closely with the business lines. And one of the topics that I think is relevant to what we have been talking about is agentic commerce. I think there's a lot of hype around it, and I think it is inevitable.
Yeah.
But it is literally being built today.
Yeah.
The protocols are evolving, the partnerships are like partnering, and it's all moving very quickly. We're one of the first organizations to join the MasterCard Agent Pay, which allows us to understand a little bit more about tokenized credit cards and how payments will interact in this new kind of agentic commerce. But, you know, we have yet to see that value from actually discover to selection to actually making that purchase. And so while the payments are, you know, relatively ready, there are a lot of questions that I have that I think the industry as a whole have around, you know, what are customer adoption rates? You know, what experiences do they want to outsource completely to an agent, and which ones do they want to have more control over? Also around the brands and merchants, like, you know, do they want agentic commerce to be their number one channel, or do they want to retain their existing channels with their websites and, you know, customers?
Well, and if you contrast this, right? Money 2020, where we all were, right? Like, if you looked at the logos and what was being talked about there, you would think agentic commerce was the number one issue facing, you know, the world writ large right now.
Yes.
Yet if you talk to consumers and merchants, like you just said, or even businesses, I don't know that we're necessarily ready for it. The value isn't necessarily there that we're ready to give up control. You know, Alex, your self-driving money aspect, right? Like, I don't think people are ready for self-driving purchasing. Do you?
Well, I mean, I think it's a really good discussion, because sometimes I feel like we sort of decide without talking to customers, like, you need this. And it's like, do I? Like, is that what there's in fintech, they always reference that Henry Ford quote, if I'd asked customers what they wanted, they would have asked for a faster horse. And it's cute and it's a nice story, but it's like, actually, maybe we should talk to customers every once in a while. Like, we shouldn't always be trying to like invent a future without talking to customers or thinking about what they want. And I think that agentic commerce is a really good example. You know, we've spent the last couple of decades making e-commerce really efficient, right? Like, if I want to buy something, there are very few points of friction or barriers for me buying something. Now, there are use cases where AI can add value to the discovery process, the research process. Like, I'm not saying it's not useful, but if I was to, Jason, to your point, like, stack up what are the 10 most pressing problems that financial services consumers have that are unsolved currently by banks and fintech companies, shopping would not make the top 10.
Single click checkout, like the billions spent on it.
So it's like we're trying to like optimize this thing that's already hyper optimized because that's where we make money today. And we're not trying to optimize the thing that might turn into a great business that adds more value to customers, right? I mean, one of the examples I think about a lot with agentic AI is, you know, where are areas where customers' financial choices are non-optimal because of inertia or lack of education. And like, you know, I always use the analogy of comparing financial services to healthcare. And I think in a lot of ways, it's very similar, right? It's heavily regulated. It's focused on outcomes. It is life or death, you know, like you have to take it very seriously. But one key difference is, like, if I want to get healthier, there's no substitute for me going to the gym or actually eating healthier. Right? There's
Yep.
very few ways to like become healthier without actually changing your behaviors. In financial services, I can have an AI go to the gym for me, right? Like I can have agentic AI go out and optimize from a treasury management perspective, like where I'm getting yield on my deposits. I see very few companies building agentic AI for those use cases. And instead they're like, what if commerce was like 2% more efficient and streamlined? It's like, yes, but is that the number one thing which people are saying?
Yeah. I think to that point as well, the infrastructure being built around agents
Yes.
and making transactions. So how do we identify and authenticate these agents and giving them, right access to legacy systems? Like, how do we all feel about that? And, how do we lock that down and preserve our trust and security that we have as, a regulated entity?
Well, one of the things that's interesting about that, I was talking to someone at one of the card networks, right? And they were saying, we just got done spending 20 years trying to keep bots out of all of this. And now we have to let bots in and sort the good bots from the bad bots. And so like it's a great point about infrastructure. The infrastructure has to change completely to allow consumer authorized agents to transact safely within these environments. And on top of that, when the consumer agents are transacting, like how do we understand the intent of the consumer? How do we make sure that the agent is acting in accordance with their intent? How do we resolve any problems, right? I mean, like you thought chargebacks were annoying. Chargebacks are about to get way more annoying in the age of like agentic.
Well, especially when it's agent to agent, right?
Yeah.
Like my agent made a purchase that I don't like, and so now I have a different agent talking to your agent about doing a chargeback for this, right? And an escalation of agents.
Right. And the regulators are like, so what's that? And you're like, right. Like these things are they're moving so fast. And that goes back to what we were saying about like the speed at which we are embracing this technology. I mean, not to go too old fashioned, but like 100 years ago, when some new piece of technology came out, we spent decades wringing all the possible economic value out of that technology before the next technology came out. And so we used to be a lot better about kind of tying technology innovations to customer value. But because the pace keeps going faster and faster, we don't have time to pause and be thoughtful about the technology we have before next week it's been rendered obsolete by something new.
Yeah.
There was a great Plain English podcast at the end of the year, kind of doing their best up, talking about the AI bubble.
Yeah.
And part of what makes the AI bubble different, if you look at historically, I hadn't really thought through how far back you can go to bubbles. The fact that there was a railroad bubble, right? And like we always look at the internet bubble, and that's kind of where we go. But it's like there was a telegraph bubble, like all these bubbles.
Real estate bubble.
Right, in the real estate bubbles. But normally we have the hype cycle, the crash, and then it kind of builds out the value. We're stacking bubbles right now as part of where this goes. It feels like one of the challenges, Megan, picking up on your theme, it feels like our narrative is running outside and faster than the value creation. I'm curious from both of you, where do you feel like the narrative is either moving faster or rewriting the narrative to kind of translate into what we want? And one of those things, going back to Money 2020 for a second, I think of, Kia Haslett. This was her first Money 2020 since she left that other publication. She's texting Alex and Jason Mikula and I going, it's like, I'm watching this stablecoin presentation, but it's really like blockchain that they just have rewritten the narrative to say stablecoin. Where else are you finding this disconnect between the narrative is running out ahead of the reality?
Yeah. Yeah, that's an interesting question. And also with the Money 2020, I think it was Money 2020 and 2024 where I got back from that trip and I went to our blockchain team that's within the innovation team and I said, get ready, stable coins are coming.
Yeah.
And then, the summer of 2025, the Genius Act was passed and we actually, in terms of being able to identify these trends and make organizational changes, we created a digital assets and money movement team, actually, that is a full organization that has dozens of work streams on stablecoins, programmable money, tokenized assets. And we actually just partnered with the Stellar Network, which has over 9 million unique wallets and over $1 billion of annual payment transactions to really understand like are stable coins, faster, cheaper, and real time. But if you add on KYC and all the regulatory requirements. What does that look like from a stablecoin perspective? So we're actually testing that
makes sense.
with
Yeah.
the seller network around, unwinding and freezing assets to be able to test that. So
It's fascinating. I mean, whenever these new technologies sort of slam into the way that we do things in financial services, crypto is probably the area where this is happening really fast and kind of speed running history. But you find out that like there are reasons why we do certain things,
Yeah.
right? And I think Jason, to your point about like where's the narrative sort of outrunning reality, I think a lot of it is kind of coming back to, well, now we have X, we have stablecoins, now we have agentic AI. So that must mean that all of the constraints that existed before no longer apply, right? And stablecoins are a good example. To your point, you still have to do KYC with stablecoins.
That is the hard part. That is the expensive part,
Well,
not
it
the
is.
transmission.
exactly.
Right.
Yeah.
And I've had this debate with people before where they're like, well, stablecoins are cheaper. I'm like, it's cheaper than Visa moving a number from one row in its database to another number. Like, it's not cheaper than that. Like we have electronic money movement. We've had it for decades. Like, that's not the hard part. We're not actually shipping gold bars across the Atlantic Ocean. The money movement is not hard or expensive. Where the 2 to 3% fee comes in is all the network rules, all the chargebacks, all the fraud management. Like that, running a network is expensive. Managing the competing incentives of different parties so that it just works whenever you pull this thing out, that's expensive, right? And so when I think about, stablecoins are a good example. I think there are use cases where stablecoins are infrastructure that is superior to infrastructure we have today, particularly if you're moving across borders, particularly if money needs to move instantaneously. There might be a benefit to programmability. Like there are things that might be valuable here, but ultimately it's going to have to run on and rest on rails that are similar to the ones we have today, which is why, when you look at the stablecoin space, Visa is a huge player in stablecoins. PayPal is a huge player in stablecoins because they know how to do those other hard parts, and the stablecoin is just a new rails.
They're the network. So,
Right. So like it doesn't get rid of the need for networks, even if the technology underpinning the network evolves.
I think it's interesting to compare like the agentic commerce and the stable coins and how they're driven in different ways, because the regulation with the Genius Act really put stable coins on the map and accelerated that development. Whereas the AI is more driven from the hyperscalers that have a bunch of funding from, venture capital and private markets. And so I think that they are similar in terms of, where they are within their hype cycle, but also driven by very different, incentives.
Well, and that's a good point too, because like stablecoins it's so funny that stablecoins are the crypto thing that have kind of broken through the most, because stablecoins are intentionally boring. Right? Like if you take all the stuff we've seen in crypto over the years, the thing that always scared off institutions was, yes, but, and then they point at like speculation, fraud, scams. They pointed all the like nonsense. And so stablecoins, by their sort of definition and the way they work, are crypto stripped of all that speculative nonsense. And so there's a reason why regulators have gotten more comfortable with them. There's a reason why central bankers like stablecoins. Like those things make it more of a mainstream technology for financial services. I think to your point about AI, I I sometimes judge these things based on like the size of like seed rounds I see invested. And I think we have to retire the term seed round, because like these AI startups, that are focused on financial services or focused on other areas, they're like, yeah, we raised $120 million seed round. It's like, I don't think that word means what you think it means, And so AI is just moving at a sort of speculative fervor that is totally different than stable coins, in my opinion, even though they're both hot topics of the space.
I totally agree.
Well, stealing one of my points for our conversation with Simon Taylor later today, in my view, if a stable coin is successful, we won't be talking about it 5 years from now. It will just become plumbing.
An invisible rail.
An invisible rail that is powering other things in use cases. And
well, it's like, how many people talk about ACH? Like, unless you're talking to like deep payment nerds, ACH isn't an acronym that comes up a whole lot.
And normally it's a 4-letter word.
Well, right. And to a degree, you kind of want that with stablecoins. You want them to be like, oh, stablecoins, can you believe how annoying this is? Like, that would be progress.
Yes.
To turn stablecoins into something that is just routine, mundane, kind of annoying, as opposed to say stable coins and VCs just hand you money. Like that's the gap or the barrier we need to jump over.
So what else fits into this cycle that if we have the benefit of 5 years from now, we look backwards, what are we overestimating and underestimating in terms of what these cycles are going to be, either predictions or new technologies, which are going to stand the test of time?
That's a hard question. I mean, I think that from my perspective, again, like financial services isn't actually going to change as much as we think, right? And so these kind of existing product categories that we have, the question I think you always have to ask is like, where are we going to see, where is this like a meaningful actual step change improvement in how we do an existing thing? And so like, you know, one of the examples I go to a lot, and it's a little messy right now from a regulatory perspective, but like open banking to me is one that we are going to see durable value continue to be created around over time, irrespective of what happens on the regulatory side, because turns out the ability for consumers to granularly permission access to their financial data and use that something as a passport to unlock better experiences and better products wherever they go, that's valuable, right? And it's interesting actually because it maps to larger trends that you're seeing, right? When you talk about AI, well, what's one of the most important sort of consumer aspects of this boom in AI? It's can you take your context and your training data and move from ChatGPT to Claude to Gemini and back and forth? Do you own your training data and your context? Can you output that to others? And so I think actually a lot of the hard, annoying, wrestling in the mud work that we're doing on things like open banking will actually have a very long tail of value because once we continue to kind of move that ball forward, like lenders can use it and not just in a second look fashion, but like in a mainstream fashion. It can be useful for AI and agentic commerce and some of these things. So to me, there are these more, I guess I'd call them kind of boring things that, you know, if you're a VC and you're just chasing hype, you've moved on from open banking a long time ago.
Yeah.
But to me, like that's the slow rising tide that kind of lifts everything else up.
There definitely is a lot of promise with the open banking. And I think of, as you were talking about preferences, even like digital twins and being able to cite your preferences and have that, you know, following you around in terms of.
Can I pitch you an idea on that?
Yeah,
All right.
please.
So this
Can
is,
I invest?
this yeah. Well, you'll want to. You'll want to after you hear it. So like a good question I've been noodling on, I think, is when you start a relationship with a new bank or financial services provider, we now have the capability, though it doesn't exist as far as I know, for like a digital twin of you, the customer, to be born at that time.
Yeah.
And so you open your account and the Alex AI is started at that moment. And it basically just acts as like, it gets CC'd on everything. Like every email I get from that provider, it gets CC'd on every call. Every time I call into the call center and recognizes my phone number, it dials in my AI and listens and just creates like this context map of my entire relationship with this organization. When I add a second product, a third product, a fourth product, it just gets smarter. And I think to a degree, you know, it helps consumers navigate the complexity of working with an organization, right? I mean, large banks, and you know this, like they're big, they're complex, they have multiple parts. Sometimes it's a little confusing for customers.
Systems.
Yeah, and it's like, why are we not leveraging technology to create shortcuts for customers to better navigate that stuff?
And it not only helps the customers, but also the bank to be able to meet the customers where they're at and provide them with, you know, helpful products.
That's exactly right. I mean, like think about like if I had this digital twin, you could communicate with me, but also it, and then it could tap me on the shoulder and go, hey, I know you get a lot of emails and a lot of messages from all the providers you work with, but this one you should really pay attention to because I think it might actually help you with these 3 goals.
And so is that the role of the twin, is not to be a substitute for you, but to be a proxy for you?
I think like a proxy, an advocate, a problem solver, right? And so it doesn't replace my ability to talk to Meghan or to walk into the branch or whatever. Like it doesn't replace that or get rid of that, but it just sort of supercharges my ability to get value out of this relationship.
And be able to express your preferences and goals and things like that.
Yeah. I mean, it's like you know how when you have a really great customer service experience where you get connected to someone in a call center who's just like a ninja and just jumps across all these systems and just fixes your problem, like That's why people persist in going, no, I want to talk to a human. No, I want to talk to a human. Like, they get to a human because the human can bypass the problems or the barriers or the structural nonsense that exists inside every company and get to an answer and get to a resolution. Why can't we build that as like an agentic capability for every customer when they sign up? To me, that's very doable now from a technology perspective. But going to your point, it does require a shift in mindset, I think.
Yeah. Well, I'm ready for it, Alex AI.
Okay.
Alex AI.
You heard it here first.
Yeah, I might be launching an entire suite. I'm getting a Kia AI for all of my rewards point management.
There you go.
And
There you go.
my Alex AI is my digital twin for better customer service.
Hey, let's take a quick pause here because I want to tell you about a conference I actually like. If you've ever gone to a FinTech event, worked the room and left thinking, I met a lot of people, but nothing really moved, you know the problem. FinTech Meetup is different. It's designed around outcomes, not wandering the expo floor. And that fits us well, and that's why we appreciate their support of the show. Last year, people booked more than 50,000 double opt-in meetings. And that matters because it means you're not guessing who to talk to. You're sitting down with buyers, partners, and decision makers you actually want in the room. That's also why Jason is spending time there this year. He'll be leading a very real, very grounded conversation on AI, no hype, no futuristic nonsense, just what's actually showing up inside financial institutions and what leaders should be paying attention to right now. So if you're already thinking about your 2026 calendar, tickets are already on sale, and you can save if you register before March 6th. Just search FinTech Meetup and check it out.
So, Megan, I'm really curious how you balance this because you have a foot in both worlds.
Yeah.
And, well, kind of three worlds. One is the hype cycle building up. The other is the crashing. And then the phoenix rising from the ashes where that adolescent that is fintech right now suddenly realizes maybe mom and dad are so stupid, at some point being a parent.
Who's mom and dad?
It is hard. Well, in this case, right? Like, I think about the cycle of like, once upon a time, my children thought I walked on water. We have now begun to enter the phase starting at 9, where dad is not nearly as smart and cool as he used to be.
I think your wish that they're going to come back around is going to take longer than you want, but eventually it will, right?
Eventually. But I think the same is true of fintech, where we are in the hype cycle. And you've got a business that, Alex, you made this point of, I think in the short term, it's financial services is not going to change as much as we'd expect, but in the long term, it absolutely is.
And I think we're kind of already starting to see that from like the capital markets perspective. I mean, the IPO markets opened up a little bit in the second half of last year, which was really great for fintech to get some liquidity back and see some wins that the investors had. At the same time, we're also seeing, M&A heat up as competition becomes more intense. And that's, bank to bank and then also bank to fintech.
Yeah.
I mean, Capital One just acquired Brex. And we also at US Bank just acquired a financial institution, BTIG, which is going to create new products for capability gaps within capital markets.
Yeah.
So they're able to provide equity trading and M&A advisory services that are very complementary for our corporate and institutional clients. So we're really looking forward to that. But I anticipate a lot more M&A and consolidation in the market as we look at what the future of financial services look like and how competition is really shaping up right now.
What other predictions do you both have as we're sorting out signal to noise right now? Where do you think those true signals of value are going to come from that we're going to say these are the trends we really need to lean into, even if they have a hype cycle attached to them in the short term? This is going to be long-term accretive to the industry.
Yeah, I think payments is, top of mind. That touches agentic commerce and stablecoins and an area that we've been investing a lot in. And you're seeing that also within the trends of M&A as well. So I think payments will definitely see a lot of value over time.
Yeah, I mean, building on that point, I think one thing that's been really interesting to watch, and it goes to your earlier point about M&A as well, is I think it takes a long time, and just maybe using your analogy of like kids becoming teenagers and then becoming adults, like when you move out of different contexts, you suddenly sort of understand the world differently, right? So, like, when you're in high school and you're living at home, like, your parents are idiots and your world is relatively like self-contained, right? But then you go off to college and suddenly all of those constraints are removed and you like impact the real world and sort of learn more. And you suddenly have a slightly different appreciation for maybe some of the things your parents were droning on about that you weren't listening. I think that similarly inside of financial services, you know, M&A wasn't possible for a while, right? I mean, like, regulators were just not comfortable with like banks acquiring banks, banks acquiring fintech companies. Like, it just wasn't possible. And I would almost equate that to like being in high school where you just didn't have a lot of freedom. So it's like, what am I going to do? I don't know. And now, like, we're sort of in that college stage of like, hey, man, you want to go over here? Go for it. You want to go to that party over here? You want to become friends with that person that your parents
Fruit
really
Loops
want
for
to
dinner.
Go
is
for it.
cool.
Fruit Loops for dinner is fine. And I think that when with that expanded freedom, we will see both sides of the market, right? Fintech companies and banks kind of think differently about value and like what, you discover yourself a little bit more when you're in college. And so like to me, one of the things that's been true in financial services for a while, but that banks maybe haven't totally appreciated is product is now the thing that wins, right? Like distribution, as much as it's historically been an advantage for banks, now anyone can get to any one of your customers, consumer, small business, corporate, without having to have a human sitting in an office somewhere or a branch down the street. And because of that, what wins is the best product, right? And like that was what was behind the Brex Capital One deal. Capital One said, we don't think we can build a corporate card expense management system that's as good as what Brex has built, but we think that product will drive customer choice and we want to buy that product. And so I think we'll see a lot more acquisitions focused on products and product leadership. And, going to your point about payments, you know, payments innovation is great and Rails and all these things are great. But at the end of the day, the payments have to flow to and from different operating accounts, and the operating accounts have to work well for the users. And I think historically, banks have not done as good a job building awesome tailored operating accounts. So,
What do you think? I've got some strong views on what Alex said.
Yeah, I mean, primacy is definitely an area of opportunity. And so we have a lot of partnerships with various fintechs that can supplement that primacy and really make that like an operating account for customers. For example, our partnership with Atomic makes it easier to switch over your direct deposit and manage your subscriptions and billings. And just having that be like the operating account, is something that we're working towards and providing value added services around, kids debit accounts with green lights and other areas to differentiate within the banking space is something that we're looking at as well.
So I'm going to extend the line even further in terms of where I think we ultimately end up is not even the products, which I think is a good shift. We're going to end up at the outcomes. That I think one of the promises of AI, a trend I'm interested in thinking more about is how does AI actually help us really understand, given our individual context as a consumer or a business, the choices we make and go measure, did I receive the outcome I was looking for? I think Atomic is a great example of this, right? Which is the product helps you get over the pain of switching accounts is actually really painful.
Yeah.
And especially the tightrope that is, I've got inflows and outflows that have to be carefully managed and mapped and timed. But the outcome is not the product. The outcome is actually smoothly getting through that with minimal fees.
And that you're able to be up and running and proceed on with your day to day.
Yeah, I agree with that. I mean, I think, and I'd be curious, Megan, for your take on this, but I think one of the hardest things for any company to do is to sign up to hold itself accountable for higher results, right? And so it's like we always, in like human nature, we always want to sort of like have the lowest possible expectations so that like we can exceed them easily and we don't have to like stress ourselves out about it too much. But I think that really great organizations sign up to hold themselves to higher standards or higher results than the market or their customers necessarily force them to, right? And so to your point about outcomes, I think a huge shift is going to be when you start to see companies say, we are going to measure outcomes for customers. We're going to hold ourselves responsible to those outcomes. And we are going to train our customers to expect that any institution they work with will do the same. And like, as soon as you see that shift towards like, well, okay, you've been working with this bank for the last 10 years. How has that materially affected like your path to building wealth, your path to building financial security, your ability to plan out your kids' financial futures? Like, have those things gotten better or worse over time since you've been working with this institution? And to me, that could not be a more important shift, because at the same time that that's going to happen, we also see a ton of companies, and I've written negatively about a lot of them in the newsletter, where they're just focused on, hey, we're going to create a gambling app that's super fun. Come have fun, and like shopping, wealth management, like there's a dark side to all of these activities that's very engaging, very profitable, and very much like tuned to people's sort of worst instincts. And you can build a great business there, but you're not going to drive great outcomes there over time. And so I'm really hopeful that we will see some providers in the space anchor on, we want to be held responsible to the outcomes we drive for customers long term. That's the hill we want to die on.
Yeah. And I think that's a really good differentiation between short-term gains and long-term gains.
Yeah.
There are a lot of fintechs that, claim that they have, financial literacy or, financial wellness, and it's really just kicking the can down the road.
Right.
And so, short term you have wins, but long term, you're in some trouble if you continue on.
Well, totally. I mean, a really like precise example of that I think we've seen, and so it's a really good instructive one, is like, hey, we're going to give you a loan to pay down your credit card debt. Fantastic. But if you then just fill your credit card back up with more debt, did we help or did we hurt you?
Yeah, we emptied the bucket so you can go fill it up. But you also, by the way, have a full bucket over here now.
Right. That debt's not going away. It's not like it magically got wiped away. And so I think that like the impulse often is good, right? I mean, one of the things I do like about fintech is a lot of people get into this industry with a genuine desire to help other people. But if you're not thoughtful about how your product is going to get used, and again, you're not holding yourself to outcomes that you're responsible for, and you're thinking just mechanically about how the product works, you might build a product that actually moves your customer the wrong direction, which is not what you intended. It's not what they wanted, but the product design and being thoughtful about that really matters.
Yeah, absolutely. I think a great example of that is actually around like the credit scores and lending right now.
Oh my God, you're going to like cause me to flip out on this podcast.
Go trigger Alex.
Hot take.
No, play it out. When we think about credit scores and some of the unintended consequences, how it's changing behaviors? Play that out. What are you seeing where I don't think some of the innovators get the full context of the impact their product is having?
Yeah, I know you had a lot of thoughts on this, but I think just from my perspective, like I think that these alternative credit scores are good in the short term, but when you're not reporting to credit bureaus and on various things, it does impact your long-term outcome for financial wellness. But curious on your thoughts.
We don't have enough time for all my thoughts on this subject, but I will say, building on your point, and going back to that piece you referenced where I was talking about 2026 priorities, one of the ways I was thinking about it was sort of a blend of predictions, what is going to happen, with resolutions for the industry, what do we want to have happen? And one of the most important resolutions that I have for the industry and that I hope others adopt over time, because I think it's incredibly important, is leave the ecosystem better than you found it. And that's a tough one because everyone's incentives narrowly are to do what's best for them individually as a company, even if it sort of messes things up for the larger ecosystem. And I think credit scoring is a great example of that. Like, well, why should we furnish data? It's our data where it's proprietary to us. Like, we shouldn't have to share this. And the answer is, it is better for the ecosystem and better ultimately for your customers if we all have a shared understanding of how good a risk they are. It unlocks opportunities for them. It makes the ecosystem as a whole more efficient. We can price risk better. And so we are going to ask as an industry that you act like an adult and play nicely and lead the ecosystem better than you found it. And I think that is something we continue to need, like really try to hammer home and get people on board with. And I hope that regulators can reinforce that idea as well, because like if you don't do that, everyone will narrowly like optimize for their own self-interest, and we end up with a more fragmented ecosystem, which is not what we want.
Yeah. I think KYC is a similar analogy.
Oh,
Alex,
totally.
you and I probably talk about KYC more than any two individuals should. But, we think of it as friction for me that I want to do away with. But what we miss is on the other side, if the other party does not have good KYC, that's enabling, the bad operators to be that account that is stealing money, that is being the pig butchering scam, that is getting, you know, grandmas and grandpas to send money to, right? Like that is the outfit.
It's a great point too, because we never talk about this. We always talk about it as like the origination of the problem, but like a scam, the money has to end up in some other account. That's the bad guy's account. How did they get that account? Like, to your point, we all have to hold ourselves to higher standards to keep people out of a system, because if the bad guys have an account over here, then they can start running scams and moving money over there. And so it's a two-sided network. Both sides really matter.
So as we wrap up, what piece of context for the innovators out there would you leave? Because we ended up spending a lot of time around context, both around AI and around what is actually signal to noise. What would you project into the market to manifest to say this is the thing, whether it is an internal bank innovator or a startup beginning to, think about their journey? What context would you give them and say, you need to think about this?
Yeah. I would definitely consider thinking about, a foresights framework to understand how these signals are actually driving long-term outcomes and what that means, and how you take those actions today to build towards that future for everybody, for the innovators in the bank, for the banking regulators, for fintechs. And so I think that that's really important in today's economy.
Yeah, I mean, building on that, I think that going back to something we've been talking about over this whole conversation, technology is moving really, really fast. And there's always going to be some new trend. There's always going to be some new product, some angle of competition that emerges. And like, what do you anchor on, right? What do you always come back to when you're evaluating these things, right? I mean, you guys do this all the day. Like
value props, business models, unit economics.
You have to have some point of reference that you anchor back, or you're just going to get swept along in the stream with everybody else. And to me, the thing that's really missing a lot, particularly in fintech, is anchoring on values. Like, who do we want to be? What do we want to do for our customers? What's our opinionated view of how the market should work that doesn't work like today? And how can we move closer to that? And that's something that can be a long-term thing you anchor on, so that when all these pitches are flying by, you know which ones to swing at, because you're anchoring on values. And I think when we optimize for growth, or we optimize for clicks, or we optimize for raising money from VCs, we lose track of like that anchor point, which is value.
Fantastic. Well, thank you both for a very enlightening conversation. I look forward to listening to this 6 months from now and seeing what we got right, what we got wrong. I don't think it's going to be a year anymore at the speed we're moving.
Exactly. Thanks for having us.
Thank you.
That's it for another week of the world's #1 fintech podcast and radio show, Breaking Banks. This episode was produced by our US-based production team, including producer Elizabeth Severance, audio engineer Kevin Hersham. If you like this episode, don't forget to tweet it out or post it on your favorite social media, or leave us a 5-star review on iTunes, Google Podcasts, Facebook, or wherever it is that you listen to our show. Those actions help other people find our podcast, and in return, that helps us build an audience that can be supported by sponsorship, so we can continue to provide you with our award-winning content every week. Thanks again for joining us. We'll see you on Breaking Banks next week.